Did you catch the, I don't know if it was Polymarket or Kalshi, whatever it is. I don't know which one it was, but somebody placed a strong series of well-timed bets on the Super Bowl halftime show and won a bunch of money for themselves.
I've seen some darker bets on there, but go ahead with the halftime show.
Well, not the dark ones. I know there are ones about like wars breaking out and all kind of crap like that, but specifically like what's the first song Bad Bunny's gonna perform? Will Cardi B make a special appearance? Will Lady Gaga also make a special appearance? Like all these different things that what color outfit will Bad Bunny be wearing? Like it's all these things that literally only you as an insider would actually be able to know. And then it was like they got 26 out of 27 of these bets right. And looking at the account's history, they never made any bets before and haven't made any bets since the Super Bowl. Nice. And so this was the one time they created a profile and logged on to do this. And people are like incensed over it. People in the Polymarkets community are incensed about it again because insiders strike again.
That is if one person can manipulate a market, then eventually one person will manipulate a market. I mean, I saw the streaker bet on himself. Mm-hmm. So he realized, okay, I think I get a $1,000 fine for streaking at the Super Bowl. No nudity. He puts on his Meta glasses. He gets a viral video and he bets that someone will streak at the Super Bowl and the bet cashes out. I mean, there is a part of me with this, Malcolm. Like there's some of these should be straight up illegal. Like there was one, it's like, will a space launch with humans on board explode? So it's like, so
now somebody's incentivized to make it happen.
Yeah, literally illegal as a contract is you can't have a contract with someone to do something like you can't have a contract with a hitman.
Yeah.
And say, hey, this was our contract. So first of all, I wonder how that gets through the system. But then second of all, there is a part of me too where by this point, everybody should know that if you're betting on whether it's an earnings call for someone to say the magic word that an analyst on that call could easily manipulate, I'm betting that Netflix is going to talk about gaming. And maybe I'm an analyst on the call and I could place that bet myself. And granted, Kalshi would say that's against the terms of service. Mm-hmm. But I'm sure you saw the clip of CEO Tariq Mansour on CNBC basically saying about the Super Bowl bets, insider trading, who's an insider is a really squishy concept. It's really hard to define who's trading and what's public information and not public information.
No, the SEC has defined it very well in all of the different acts since the 1980s that have very well defined who's an insider and what counts as insider trading. So it's not hard to figure it out.
It's just hard to say.
That's that line between what's ethical and what's legal, right? That whole debate over should you do it because it's legal, even if it's not ethical. First year law students can go through and teach you about.
All right. We're going to get into private credit, something Malcolm is very passionate about that may be breaking down. And yes, it does affect you, even if you aren't invested in private credit funds specifically. I've been doing some reporting on option whales that I think is interesting. I hope you do too. This is a exploding area of markets that I don't think people understand that well. And we've got a few of your questions. Let's get into it. Malcolm, one more thing before we do the meaty topics. I will say, I tell people what I'm doing with my money on this show. I added, since our last conversation, I added a little bit of Zscaler.
Okay.
I've been slowly building a position in ServiceNow.
Okay.
And why I'm saying slowly with both of those is anytime I think I've made this mistake in the past where you go, this stock is getting punished too much. Mm-hmm. So I'm going to make my position now. And anytime you do that, you can end up catching a falling knife even more. And so this is a way for me a little bit to protect myself and also, slowly go in knowing, I may miss out on some future gains if I don't if I don't time it exactly right. But these narratives can take a while to turn, or they can turn on a dime.
So I don't know if I told you this since the last time we recorded, but I also, well, I added to ServiceNow because I've been adding all the way down from 150 to, I guess it's now like right at 100. But also I just added to Zscaler as well earlier this week.
Nice.
Like 50% off its all-time high from October, I think it was, like October 31 to be exact. I think it hit 202 or so. I'm literally doing this off the top of my head, so forgive me if I'm wrong. But like looking at that and looking at the fact that they're growing their annually recurring revenue by 27% from their most recent earnings back in November, to me, it just looks like even if this isn't the best place to be buying it because it's the absolute floor, I'm not worried about calling the bottom so much as I am about getting into the right company for a great price. And so I understand the people who will still say, because I've heard this argument after I shared on CNBC that I was buying the stock. I hear the people who will say the company's still overvalued, but this company's been cut in half, basically. Its share price has almost been cut in half, and it's still trading at like 45 times forward earnings. It is never going to be valued at a level that makes logical sense to you if you're only focusing on the traditional multiple of future earnings. With a company that's so nascent, it's not that old as a public company. And so it doesn't make sense that it would be trading similar to like Apple, for example, or the broader S&P, because they're still in aggressive growth mode.
I think that's fair. And the two other moves I'm thinking about. One, I'm thinking about trimming some of my basically my Schwab dividend fund, the Schwab US Dividend Equity ETF, SCHD.
SCHD, yeah, okay.
Because that was something I bought when the market was on fire. Is a form of insurance, right? If the market goes down a little bit, then this is a way to hold on to a little insurance. I don't think I'll sell all of it, but right now it is shot up to all-time highs as investors rush into safety. And guess what? I have a little bit of safety. I have flexibility that I built in when everybody was only wanting to get in on AI, and now everyone wants to get out of AI. You know what? I'm thinking I want to get in AI a little bit.
I am seeing, though, some, I think it was Bank of America specifically that reported on this, and maybe it was Monday, where retail investors who have basically been leading this market since the bottom in November 2022 have piled back into software stocks, big tech stocks at a massive level. I can't remember the exact number of buying, but it's like $80 billion in 1 week, which was like the biggest number on record since B of A has been doing this research. And so while you're talking about people selling out of AI, it's been happening since October with that Brad Gerstner OpenAI interview. Maybe retail investors have decided enough's enough. We've created enough damage. It's time to swing the pendulum back the other way and start buying our favorite hyperscaler stocks again.
So you're saying I'm late to the party? And
no, I'm saying the idea that I think you were teeing up of being greedy because others are fearful is probably right. Just looking at where the momentum is building all over again.
To the listener, sometimes I think Malcolm is insulting me, but really he's just saying I'm right and I'm taking something personally.
So before we move to the other piece, though, you mentioned ServiceNow, and I also want to go back to ServiceNow because I've been very vocal about this one, and I don't want to leave our listeners hanging on this. So I bought more ServiceNow. One of the challenges that I've heard other people throw out there about this company and all of the software companies more broadly is it would be very helpful and very encouraging if you saw the CEOs of these software companies that have been selling off so aggressively buying shares of their own company, because that is what instills confidence. And from that, Bill McDermott, CEO of ServiceNow, did make the announcement that he and like 4 or 5 other of his senior officers have stopped their pre-planned selling for the foreseeable future. So for those who don't know, typically the CEO and anybody else with inside information at the top of the company has to create what's called a 10b5-1 trading plan, where they alert the SEC how many shares they plan to sell and when they plan to sell them, in what window periods after they've posted earnings, blah, 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 blah. And so they've all made it clear to the SEC, we're not going to be selling anything anymore. But to take it a step further, because that's probably not enough to help instill, it's not enough to encourage people to be buying your stock after it's been cut in half. He also said, I myself am going to buy an additional $3 million worth of shares. And the market sold. And what I think was missing, I had somebody ask me this question specifically, so I had to really think about it. What I think was missing is that's not a big enough vote of confidence. And, far be it for me to spend Bill McDermott's money for him. But what I'm thinking about is about 10 years ago, JP Morgan's stock price was struggling. And Jamie Dimon stepped in and said, look, this is BS. Our company is great. Our stock price deserves a look. I am going to plunk down $30 million of my own money to buy, it was $25 million, I think, of my own money to buy additional JP Morgan stock. And that year, the share price surged 30% from where he made that announcement. And I think that is what's missing here in all of these software stocks. I applaud Bill McDermott for trying what he tried to do, but I think it's going to take a lot more. I think it's going to take a much bigger push of those chips to the center of the table to show confidence in your company's ability to make it out of this whole thing. And, once we get to the other side of it, 2 years from now, 3 years from now, whatever, you're going to be glad you did anyway. The only question is then will you be allowed to sell, to cash in without sparking fear again? And that part I have no crystal ball on.
So a couple things I like, and I think that's a great point. Anytime I really like looking at insider activity.
I do too.
There is a saying that that is sometimes true. I can say this time is different. That's the name of the show, where they say insiders sell. It was insiders sell for many reasons, but insiders buy for only one. And most of the time, I think that's true. However, CEOs will also do it where they will do a sort of like token, I'm going to buy the stock to say that I'm confident in it, but I'm not. But what shareholders sometimes want to see is I am tying my body to the mast of this ship. And if it goes down, I'm going down with it. So ServiceNow is still more than $100 billion company. I don't know what Bill McDermott's net worth is, but I bet he's doing pretty good. There was a company.
Go ahead.
There's a company called Progeny, which did fertility benefits they do fertility benefits for large employers. So they help with like IVF that's not normally covered by insurance. Mm-hmm. The insider transaction that really got my attention from that, this was back in late 2024 on December 26th, when I believe that many people are not paying attention to what's going on in the market. One of the officers bought directly for money about more than $2 million worth of stock. I think it was the CEO. And so that's the time where I'm like, okay, this is a small cap company. You have a buyer coming in that's picking up millions of dollars worth of stock. This is very meaningful to me. And to be clear, I made a little bit of money on it, but not a ton, primarily because I think those CEOs, this is conspiracy land. I think those CEOs were counting on more government support from the Trump administration on IVF that they ended up not getting, but it was still not a money loser, but that's the type of signal I like to look for.
I follow insider buying when I can, when it's not hard to do. Mm-hmm. And because of it, my biggest position in my own personal portfolio is because it has grown so massively, not because I bought so much of it, which is SoFi. So back when SoFi was trading, I think I started buying at like $4.50. But somewhere around the $6 mark, I noticed that Anthony Noto, the CEO, would step in and make like $500,000, maybe $1 million purchase each time it specifically dipped into that. Either $7 or $6 was the number specifically. And each time he bought, I bought. And so I would just add a few more shares each time that came public. And thankfully it worked out because, it's like quadrupled or quintupled or something since then. And sometimes following the CEO, especially for a founder-led company that is early in its days as a public company, that's a really good place to be tracking that kind of info. It probably wouldn't make as much of a difference if like Satya Nadella was buying additional shares of Microsoft. But for a smaller nascent company that hasn't been public very long, that's a good indicator.
And two final thoughts on this, at least from me. One is that I would just check. You can always check what percent of, how much stock CEOs own. It's not necessarily a green flag. It's tough to tell, but sometimes you can look and go, ooh, they don't seem to be owning much of this stock for the company that they're leading. And the second that I haven't been able to find as much, but I want to look for, is when people directly below the CEO are buying stock on the open market for smaller amounts of money. Because, like anything in life, pay scales are logarithmic. So the people at the second level of a C-suite, they're doing really well. But if they're going out into the open market, they already have a bunch of RSUs and they're buying stock on the open market, even if it's significantly less money than the CEO. I think that can be a meaningful signal. All right, now do you want to do? Are we good for private credit time? Malcolm's private credit party. All right, we were talking about stocks. The nice thing about that is you can buy and sell them whenever you want. One of the problems with private credit is you can't do that all the time, and that's a problem with Blue Owl Capital. They announced that they will tighten investor liquidity in its retail-focused Blue Owl Capital Corporation 2 fund after offloading $600 million worth of portfolio assets. Blue Owl said that following that deal, the fund would end regular quarterly liquidity. How about that? Payments to the fund's investors. Seems like it's, we're going to do it based on when we sell assets. Word salad in there. Malcolm, why is this something people should pay attention to?
Yeah, so this is one of the funds that I have been talking about on this show for a while, that I've been worried about because so much of it is focused on building out AI infrastructure. And we are going to build this fund by democratizing access to private markets and allowing retail investors and individual smaller dollar investors to participate for the first time ever, because you guys have been locked out for so long, which, don't let me disparage too much, is true. It is a fact that a lot of the dollars that have been earned and made in the venture capital space, specifically investing in companies like Uber and, Facebook and Google and whatever else, have been made outside of where public market investors have been able to have access, which created a bunch more billionaires and still excluded a lot of the folks that are at the bottom side of that K-shaped economy that we talk about all the time. All that aside, this is not a standalone event. So by Blue Owl saying, basically, this thing that we marketed to you as semi-liquid and this thing that we told you was going to have quarterly liquidity opportunities is now saying, we need you to keep your money in this fund because we cannot afford to return it to you at the interval that we promised. And at the same time they're saying that, it's because the market is crumbling as it relates to the AI trade. We just talked about it's been going since October. And so you have a whole bunch of retail investors who are hoping and expecting that they should be able to pull their money back out of this thing as quickly and easily as they did when they sold Microsoft or when they sold Palantir or whatever else they owned. And I don't think that they really fully understood the mechanics of how this thing works. I don't think that the company fully explained enough and loudly enough how this thing really works. But candidly, I think what's really happening here, sitting in the middle of all this, is a lot of ill-informed people who should have known, i.e. the financial advisor that sold it to them. So my concern here is that a lot of the folks who are individual investors getting into these private credit funds are not going out looking for them. They're not calling up Blue Owl and saying, hey, can I get access to that BDC fund that's going to lend money to Meta to build a data center? They're leaning on their financial advisor to put them in the right stuff. And what I'm seeing, I just had a conversation with a buddy of mine over at AssetLink, which is a company that aggregates data for the financial services industry. And one of the things they were pointing out is that there's been this big wave of financial advisors in their 30s and 40s specifically leaving the giant mega banks and going to independent firms, sometimes taking, all the clients with them that they were working with at that mega bank. And now there's been this huge uptick where for that cohort specifically, their clients own about 20% of their overall allocation in alternatives, where the old school methodology was about 5% is enough. And so at the average was less than 5% exposure to alternatives, everything else traditional stocks and bonds. And so now in just Q1 of this year alone, still according to their data, there's been more than $600 billion pumped into evergreen private credit funds. And we're seeing financial advisors replacing the traditional public bond allocations in their clients' portfolios with senior secured debt tied to the AI economy. So now I've got people whose public equities, because 30% or so of the S&P 500 is hyperscalers, that's all exposure to AI. Now the 40% that's supposed to go to bonds is going to these BDCs and SPVs and everything else that are financing the AI economy. So now more than half my portfolio is exposed to AI. That is why people are hitting the panic button and trying to pull those dollars out, because the narrative has changed and the party isn't as fun anymore. But it never should have happened in the first place, in my opinion, because if I am a 75-year-old retired nurse who is depending on my portfolio for income in retirement, and I'm looking and seeing the price of everything go up around me and worried about whether I'm going to have more month and money someday, that is not the place where I want to take a risk with the 40% that's supposed to be the boring, slow and steady money, where the only time I really pay attention to this bond fund that I'm in is when they make their quarterly distribution to me and it goes into my IRA or my brokerage account. So this whole thing is starting to show some meaningful cracks, and the people that it's cracking on, the retail investors who are getting into these funds, are the people who can ill afford to have it happen to them. It's not the big Saudi money that piled into a private credit fund that is suddenly saying, hey guys, we need to get that money back. It's not the endowment of Howard University or Columbia or somebody that's saying, hey guys, we need to pull that money back. It's everyday investors who had these things foisted on them that are standing to really lose some meaningful money here, and it didn't need to happen.
So if I look at this Blue Owl private credit fund, and I have some follow-up questions. Good rant. That was a good one. That was one of your better rants. If you liked Malcolm's rant, let us know in the comments on Spotify. thistimepod@gmail.com is a great place to reach us. If you,
it wasn't meant to be a rant, but you didn't.
That was good. This is why we have podcasts. Is you had a story, you had a narrative arc to it. You landed the plane. This Blue Owl private credit fund, I want to talk about it real quick. Not real quick. We're talking about it for a while. This Blue Owl private credit fund, when I look at the diversification of it, which they publish in their quarterly report, which is not easy to find, by the way, I look at the fund and it looks extraordinarily diversified, where we're 12% in internet, 9% in manufacturing, 9% in healthcare, a little bit in food and beverage, 20 industries and other that make up more than a third of the fund. That's I got a question mark there. But all that's to say, if I'm looking at the surface of this fund, just the quarterly earnings report, it doesn't look like it's completely tied up to data centers being built on spec for customers that may or may not exist.
Mm-hmm. So what I've learned from reading about this is that some of the companies are playing fast and loose with what category they place the debt into. Some of the companies won't even refer to it as debt on their documents. They're referring to it as other things. They're tap dancing around, calling a thing. All because, I won't say all because, I can't blame it all on Meta, but specifically Meta spent like a year with their legal team figuring out a way to structure this deal with Blue Owl where they put in a small portion of the equity, Blue Owl put in a small portion of the equity, and then they went to like Morgan Stanley and a couple other big banks to have them issue the rest of the debt to big pension funds and everybody else who could afford to take it on. They got a special letter ruling from the SEC allowing them not to call it their own debt so that it doesn't show up on their balance sheet. There's a lot of fancy footwork that happened here. I'm not an attorney, so I'm not going to try and play one on TV. But basically what it comes down to is it opened the floodgates for other companies to be able to structure their deals, their BDCs and special purpose vehicles the same way. And so there's so much of this floating out there that we don't know because it doesn't show up on the balance sheet in its traditional way. And the new rules that require companies to report their depreciation as an actual line item that we can see through with these data centers doesn't kick in until 2028. So all of the regulation that people are hoping for that's going to, one, solve the Michael Burry problem. I'm conflating two separate things here for a second, but there's a reason why. Michael Burry pointed out the idea that these companies are depreciating these assets that should be dead in 3 years over a 5 or 6 year period instead, so that they can show more profits. They also aren't required to show that depreciation on their balance sheet. They aren't required to show the depreciation expense yet, because they're not realizing the depreciation. However, the new rule that goes into place in 2028 will require it to be more of a see-through. But until then, we're kind of flying blind here. Separately from that, the companies that were supposed to be asset light, and that's the reason we wanted to be owning hyperscalers starting in 2023, and the reason everything went up and to the right with the Mag 7, they're no longer asset light. They're asset heavy. They own a whole bunch of data centers all over the country. And once they finally get delivered, they finally get built and delivered, and they do show up on the balance sheet as assets. Now we have a whole depreciation expense that we have to kick in that's going to wipe out a ton of those gains that we wanted to own these companies for in the first place, if they're required to show it as debt. And that's the fancy footwork that has allowed this whole thing to carry on for so long. So all that to say, I would not be comfortable tying the fixed income portion of my portfolio to the debt of companies building these data centers and building the AI revolution, because I just don't know what I'm going to get 2 or 3 years from now.
And not only that, to your point, you're already exposed to it if you own Mag 7 stocks. So
if you own the S&P 500,
yeah,
or you own the Russell 2000, like if you own anything that's an index fund, or if you own a large cap growth fund, because you can't be a large cap growth manager who's worth your weight in anything who doesn't own some of this hyperscaler exposure. So one way or another, unless you're picking your own individual stocks and you don't own any of the tech names we're talking about, you're exposed.
And I would say if you're working with a financial advisor, might be a good time to check and just look at the fixed income portion that your eyes might glaze over on it to see if you're in any of these private credit funds. It's a good question to ask. One place I do want to back up just for some listeners. So Malcolm mentioned that they're extending their depreciation of these chips. Mm-hmm. And so the reason that's important is because depreciation is a non-cash expense. It's not, it's something where a business will slowly write off the cost of acquiring a big asset. And sometimes they like to do that very quickly because they can get some tax savings up front. But what Malcolm is saying is that they may be a little fast and loose with saying how long these assets can last. I'm betting that my 2012 Nissan Leaf that I just bought for $4,000, I want to write that off over a 20-year period versus a 3-year period. So that's functionally what's going on. That's an extreme hypothetical example, but that's functionally what's going on with regard to what Malcolm is saying. And then the last thing I will say is, because I've said it on the show before, there's no such thing as private semi-liquid. I almost said there's no such thing as private credit. There's no such thing as semi-liquid. That is the third line on a pregnancy test. You are either liquid or you are not.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
Could I go back to your Freudian slip real quick, though?
Yeah.
Because I don't want our regular listener, our regular listener, to think that I'm just beating up on private credit for the sake of doing it and I just am anti the space altogether. there are legitimate and good private credit funds. The whole idea was the regulations got too tight following the financial crisis in '08. And if I'm a company that's got $100 million in annual revenue, $500 million in annual revenue, $1 billion in annual revenue, it's way too tough and the process is way too long for me to go to Bank of America or Wells Fargo and request a commercial loan, because the regulations had clamped down so tight that they basically could only approve loans to giant megalopolises that have entire finance teams whose job it is to keep this information up to date and be able to fill out these documents and answer questions and whatever. So then the private credit sector stepped in basically to say, we need a lot fewer questions answered. We can look at your business model, how quickly you're growing, look at your bank statements and just see the trajectory there and make a loan based on that. And so we are going to do it off book, so to speak. We're going to do it privately. And we're going to check in with you on a quarterly basis to make sure your numbers still look good. But we can issue you that debt within a month instead of 12 months. Like, that was essentially how this whole thing got spun up. But as is the case with most things, they ran out of people to make those good deals to. After 5-10 years of operating in that space, also it became more popular and the banks started looking and saying, wait a minute, like, we could create a separate arm that participates in that too, that isn't technically part of our bank. So they're not under the same regulation. So they can go do that too. And then someone else saw it and said, me too. And someone else saw it and said, me too. And then this whole thing kind of spawned further and further out of control, where now we've got to go find newer and different and other companies to make these loans to, because we've taken in so much capital from would-be investors that it's got to go find a home. And that's what's created this issue, is too many dollars chasing too few quality deals.
I know you're in a lot of these meetings with people selling private credit.
I refuse to take the meeting at this point.
At this point, I was going to ask you, I was going to say, were there things in those meetings that caused your BS radar to go up?
Initially, no, because the story I was hearing a lot of times made sense. But now what I'm hearing, I mentioned the term evergreen before when I was highlighting Asset Link's research. What they're creating is these evergreen funds, like you're probably familiar with BCRED from Blackstone. It's one of the flagship funds that represents private credit. It's an evergreen fund, meaning you as an individual retail investor can contribute $10 million, $10,000, $10, probably not $10, but you can contribute a few dollars to the pool of capital that is available in this fund to go make a private credit loan. And you participate in all of the sales that we have, all the positive activity, but you have no clue what we're going to go and buy or invest in or lend to with those dollars. It's evergreen because it can go literally anywhere, and it's meant to be open-ended and we do what we want. It's discretionary. That's the word I was looking for. So now that the evergreen fund has become the more popular fund of choice, I'm not even interested. Like, I would have been interested in a fund that was building out data centers on behalf of Silicon Valley 3 or 4 years ago. And it would have made sense to me then to hear the story and potentially even be investing in that. But the people who are offering it now, 4 years later, this late in the cycle, I'm not interested in hearing about a specialized BDC that's going to do that any more than I am an evergreen private credit fund.
Well, one of these days, I hope you take a reporting trip to the CAIS Summit. I think it's CASE. Is that CASE Summit?
CASE, yeah.
I hope you take a reporting trip on behalf of our show to the CASE Summit, because I thought this was a very interesting quote in Bloomberg. This was in a story they did about, they've been doing a series on private credit. Franklin Templeton's chief executive officer, Jenny Johnson, had a clear answer as to what makes it all worth it for her. Chief executive officer Jenny Johnson had a clear answer as to what makes it all worth it for her. Quote, "It sounds kind of funny, but we do God's work. We help people achieve the most important goals of their lives." End quote. Malcolm, it sounds like you are on the other side and you are uninterested in helping people achieve their goals. But
I don't know when that event was. I probably wasn't invited, but I would call that the top. Whenever that was the top.
Let's move on to options whales. We've been cooking on private credit for a while. So for the I think we started with 4 listeners. For the 2 who remain, I want to talk about options whales. This is a story I reported for The Indicator from Planet Money. Big shout out to them. I really enjoy working with them. And I would recommend listening to the show. It is very rare to find free media content where the work you are getting goes through a fact checker and goes through a lot of thought and care. And that's exactly what happens on The Indicator. So I appreciate them letting me play in their sandbox.
You mean tell me we should be funding public radio as a service?
Public radio is in fact a service. And sometimes it's good to have media projects where people are spending a lot of care and attention on them.
Why hasn't anyone told the federal government about this?
Multiple editors. I think someone tried. I think they have other private jets to pay for that we gotta pay for with our tax dollars. So high level, interesting story to me in the markets because how much it's grown. Options trading has grown. In 2019, traders, and this was according to the CBOE, Chicago Board of Exchange, they do a lot of the options action. 2019, traders exchanged about $5 billion worth of options. Last year, it was $15 billion. And what's been going on with this is a few things. One, I think you cannot undervalue the speculative activity of retail investors. I've played with options. This isn't a moral judgment. This is just what's going on. More retail investors are speculating with options. You get more action when you can bet for shorter windows of time. Now there's more games to play. So in the past, institutional money was buying options on months-long bases. So it could be 1 month, 3 month, 6 months. Now that's collapsed into weekly options. And even for some Mag 7 stocks or big stocks, it's daily options. So there's more games to play with, which can lead to more speculation. And also just there's greater activity that the institutions can get involved with. Mostly what's going on with whale trading. And I spoke to Amy Wu Silverman, who's the head of equity derivatives for Royal Bank of Canada. And I spoke to Mike Coe, who is the founder of Open Interest Pro. He's on CNBC a little bit as well. And what seems to be happening in a lot of cases, the institutions are buying insurance for their portfolios. So they'll make big options trades because they're trying to, they don't want the S&P to go to not zero, but they want a floor, especially if they're investing people's retirement funds. There's also algorithms that are trading volatility, trying to juice out some income through complicated algorithmic trading for different ETFs. So a lot of these whale activities can show up where someone goes, oh, this person is really bullish on Meta stock. But in reality, they may be buying insurance on the stock for a different leg of their trade. So it's one of those things where you want to read in a little bit closer to what's going on. And I also had the Unusual Whale CEO, Matt Sancombe, who helped us look into the Taiwan semiconductor bet, which we talked about on the show a couple of times, where we said, isn't it unusual that someone put $74 million on the short-term price movement of Taiwan semiconductor stock? And what was even more unusual about that is that they lost money on the bet. So you would assume when someone puts that kind of cash down on an options trade, they're going to be confident for a very good reason, because that is not a normal activity, especially on a short-term trade. And when Matt's team looked into it, they found that it wasn't someone who had a very professional connection with their broker. So all of that's to say, it wasn't a big Wall Street firm. It appeared to be someone who was very, very confident and very, very wrong. The place where things get really sketchy is within political trades, though. I think that is where people are really trying to look. If you remember when Trump announced that he was pausing tariffs for 90 days, that was back in the days of tariff press conferences. So somebody that morning bought calls on the QQQ, the TQQQ, which is they took a levered bet on a levered bet. So they were stacking on stacking. TQQQ tries to 3x the daily returns of the NASDAQ. The reason you don't want to own it for a long period of time is because if it goes down a little bit, it goes down a lot. And the SPY, I think they made about $200 million on that. And for a lot of those trades, they bought it that morning and they expired that day. So they were awfully confident that the stock market was going to rise in that day alone. But it's not something that happens on just one side of the political aisle. There are examples that have drawn suspicion specifically from Nancy Pelosi's trading account. She maintains that her husband, Paul, runs the trading account where she was buying call options on NVIDIA that seemed to work in line with the CHIPS Act getting passed. So that's the context of what I'm working on. I got one more thought too, but you can. I just threw like 18 bullet points at you. So
I was just going to respond to that very last one, trying to throw her husband under the bus, which is that maybe that works for Congress, and this is also part of the reason I'm confident that this legislation banning trading among Congress people will actually come to fruition someday. It sounds cute. But I, as a person who has a whole bunch of licenses that has oversight from the SEC and a bunch of other places, my wife's trading accounts are also monitored by our compliance team. So any trades that get placed for our entire household, it's assumed that I have something to do with those trades, whether I'm the one who actually does it or not. So that's cute, but like, come on.
I have to say it. I'm saying if someone is making an accusation, you have to.
Oh yeah. Sure. I understand. I am saying for the listening audience, that doesn't pass the smell test.
Yeah, I think you have good ears. I haven't talked about this. This is something I'm also interested in. Is I'm looking at these whale options trades. Is specifically some of these 0-day options for smaller companies. And when I say smaller, I'm saying not mega cap. Here's the process. Maybe it's interesting at the end. I think I would be curious if when I see some of this 0-day option activity, where it's a Friday and someone's buying a bunch of options that expire that day on something like a Zoom, not a massive index or a massive like $1 trillion company. What happens when someone places a whale options bet? Very often the market makers will come in, take the short position, and then buy the stock in order to neutralize their position. So they can't lose their shirt too much. I wonder if that, specifically for 0-day options, can end up having an effect on the market price, where we're placing a bet that this stock will go up that day. We're confident about it. A market maker comes in and starts creating demand for that stock, which therefore leads the stock to rise that day. I wonder if that is happening. I don't know whether or not, but it seems like with the market mechanics, that could be possible, especially for slightly more thinly traded securities.
I think it has to be. I think this is a place where AI's influence starts to really be seen and felt, because you can create an agent that scrubs for these type of whale trades, 0-day options trades, people talking about it in specific threads, different, I wanted to say chat rooms, but that would make me 60, specific places like subreddits and on Twitter and everywhere else. I called it Twitter. That makes me, 50?
You're not helping yourself.
But your agent can actually do the work of aggregating all this information that you're talking about and then feed it to your algo to say, here's the trade I place in response to that. And those things happen bang, bang. And now we see at the pre-market trading, I wonder why Zoom is up $20 a share pre-market. Maybe I ought to do something. And so now you have the humans who trade, who start paying attention to what the market is doing around 7, 8 o'clock in the morning, who place follow-on trades. And now that bids it up even further. So by the time the market opens at 9:30, we are talking about a massive swing in this solely because one person followed another person's mega trade that did have some sort of an inside edge that told them to go there.
So maybe, but what I'm saying is that this is a market mechanic story. Where the market maker has to buy the stock in order to be what they call neutral on the position. So they're
So your question is more about like Citadel
and short the stock.
Yeah. Okay.
So if I'm doing a lot of math and I look at a stock that is in that, let's say, $10 to $100 billion range, where there's a lot of activity, but it could possibly be, it has a lot of activity, but not as much as the S&P 500 index. And I buy a 0-day option and a market maker accepts it, then they immediately possibly could be buying a bunch of that stock in order to be net neutral on the position. So they can't lose their shirt too much. But in doing so, in buying that amount of stock that quickly, specifically for a 0-day option, I personally wonder if that has an effect on the stock price that could end up benefiting that trade.
Yeah. So I do know, I can't speak for all of the different brokerages specifically, but I've interacted with Schwab's trading team specifically. I imagine it's probably the same everywhere, or at least most places. But that is something that they are concerned about when you go to place a block trade. If it's large enough, we have to place this in a way that doesn't create waves in the market, that doesn't spook the market, especially if it's a sell trade. And so their trading team, part of what they do is find ways to execute that doesn't hit the market all at once and cause that kind of a ripple effect.
Let's finish up with some questions and comments that we got from you, the listener. Malcolm, you may be surprised that after revealing some of Jeffrey Epstein's swing trading activities, I got some comments on that.
I can imagine it cooked up folks online.
Yeah, people were curious. For the most part, people were curious about it. I will say this. People were interested in getting new financial details about the Jeffrey Epstein story, which is the kind of reporting we want to bring you on This Time Is Different. And Malcolm, I have to say, you weren't excited for that story. I was making a revelation on this show, but that's okay. Other people were interested.
I don't share your passion for the files in the same way, I guess maybe is the way to say it, because I don't believe in our system the way that I think some people do. I'll say it that way.
Let me try to turn a positive spin on this, because this entire story is incredibly dark. It makes me more pessimistic about the world. It's a bit like the Bo Burnham song, "This Is How the World Works."
Okay, bring the dark cloud.
It's a dark cloud. However, what I have found is that if you use this story to talk about the trading activity, you can talk about investing fundamentals in a way and get more people's attention on them than you cannot otherwise. So I could say, and I haven't found examples of Epstein doing a wash sale transaction, but he was trading a lot. So there's 600 pages in there. Maybe I'll find it. If I say to the internet, let me explain to you what a wash sale is and how that can affect you, that's not going to get anyone's attention. But if I say this is a tax mistake that Jeffrey Epstein made while he was trading, everyone is locked in, or more people are locked in. So I think there is a way to maybe teach some financial literacy from this, which is one of the angles I'm trying. Anyway, comments I got on social media about this. One is that his losses were a part of a larger conspiracy to pay other people off. I want to respond to that because I think this is a very difficult way to exchange money. If you're buying and selling options, you don't necessarily know who's on the other side of that trade, even if you're buying Radio Shack call options. And also, this was being done at a time where options commissions were like $30 to $90 on the trades that he was making. So there was a high cost to it. And I have to say, if he was trying to, there are rumors that he was laundering money. I have to think there are other ways to do it within crypto or natural diamonds or just whatever funky banking systems that he was associated with. And then the second question I got is maybe he was on purposely losing money to save on taxes, which is what I found, Malcolm. I was revealing a part of a conspiracy and people are like, there must be more to the conspiracy. And I'm like, I am very open to all of these conspiracies for the most part, especially about these files. However, I think I'm clearly making the point that this guy was just bad at trading. So they're saying he was trying to, take losses in order to save on taxes. Good time for financial literacy course, for Financial Literacy Corner. He was losing hundreds of thousands of dollars a year. And for your taxes, the maximum loss that you can take, capital loss, is $1,500 for singles, $3,000 for married filing jointly. So no, I don't think he was losing a bunch of money to save on taxes.
That's if you don't have other gains to book against it for the year, though. So you could have a $50,000 loss that you realize at the same time you realize a $50,000 gain on your whatever
other
stock
account
that's done really well. And maybe we just haven't had access to that other account where the gains are.
That's fair. I would say that given his impulsive and obsessive trading activity, I don't think that it appeared to be deliberately losing money, specifically because, I saw one BlackBerry trade, call option trade. This is what the story was. He bought some of the stock, then he saw it go up, then he sold a bit of the position. Then he saw it go up even more, and he bought more of the position. Then he kept buying in the momentum, and then he panic sold at a loss on everything. That to me is not a trader who is trying to smartly save on taxes. That is a trader who is paying for a bunch of commissions and trying to ride momentum.
Yeah, I don't doubt it. I mean, I'm not going to sit here and defend anything about the guy. I just, one of the misnomers that I have run into a few times dealing with clients and their accountants is that the thought is, oh, you lost money here, or you didn't make a ton of money this year in your trading. And if you don't look under the hood at the trading itself, you might not notice that, like, we took this massive loss intentionally because this person invested in Figma at the IPO. It got crushed, and we said, forget it. It's never coming back. Let's sell that and sell something else that we've been looking for an opportunity to take some gains in.
Good point. Last point on this, and then we'll wrap up with a question is, actually, my dad listens to the show, Malcolm. John Mulvey. Shout out,
listeners.
John. Two listeners. And when we were talking about redactions, I said, isn't it odd that when we were looking at some of the documents, this stock ticker was redacted, but they had all of the information about this company, so I could easily find out what that company was. Mm-hmm. We were talking about JD.com. JD.com. The stock ticker is JD. We'll leave it there. Let's move on to this question from C. Chalfie on Spotify. And I will tell you, C. Chalfie, we are not going to answer this question the way you would like it to be answered, but we will address it. Another great episode. Look forward to listening every Tuesday. Always well prepared, informative, and entertaining. You talked about diversification again today. Would love to hear more detailed thoughts. How would you divide up the pie amongst value, growth, large cap US, mid cap US, small cap US, international bonds, REITs, crypto? And how would this change in creating versus maintaining wealth? The reason we cannot do this question is twofold. One, it is functionally a 16-part question. It is 8 times 2. And then the second thing is if we were to start getting into specific details about how someone should specifically divvy up their assets, I think even though we have a disclaimer on the show, that could open us up to giving personal financial advice. And I don't want to get sued. I'm not making enough money on this show to handle a lawsuit. But what I will say quickly, though, is if you are asking us this question, this is something a paid financial advisor should be answering for you. And if you have a financial advisor and they are not answering this question, you may want to speak with a different financial advisor.
That's fair. I think, to that point, it's such a hyper personalized question. Like, what should your allocation be? That even if we wanted to answer it, like, in its broad sense in public that way, I don't even think it's possible to answer that question that way.
And we don't know what your savings level is. We don't know what your income needs are. So those are some of the pieces of the pie that an advisor would need to know in order to answer that question fairly. What your risk tolerance is. Like, these are the things. I understand sometimes people don't want to work with AUM advisors. There's fee-only advisors. There's a lot of ways to handle it.
There's people that work just on a project basis that will just do the one thing you ask them to do and send you off on your way. And until you need them again 5 years later, you never hear from them.
And I will say those advisors are tougher to find because it's a worse business model on the advising side. But anyway, one thing I want to leave the listener with. So you got me on Inheritocracy, which is a book. Mm-hmm. Mm-hmm. It's about the bank of mom and dad. I've been listening to it. I'm about halfway through. So we're going to have more conversations about that on the show. All right. Thanks for listening this week. I am at Rick Slick on X. You can find me on LinkedIn, Ricky Mulvey. Malcolm is at Malcolm on Money. We do have some great guests coming up on the show that I'm very excited to speak with. I hope you will stay tuned for those. Thanks for listening and hope you have a great week.
information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.